Hi, my name is Jim and I was retired. In this week's video, I will share lessons learned in my DIY retirement with viewers who might be a few years or a few decades behind me. It's now been 7 years since I crash landed my retirement when I was nearly 59. Now I'm 66 and my wife is 62. So I thought I would discuss the big mistakes future retirees might be making. Whether you are planning for a traditional retirement or end up in a forced early retirement like me, these lessons might help. So in this video, I'm going to share 3 big mistakes in your 40s, 50s, and 60s. Stay tuned. As a reminder, I am a DIY retiree. I'm not a financial planner, and I'm not selling any books or products. I'm just sharing some lessons learned. I was planning to retire at the traditional age of 65, but 1 month before my 59th birthday, I suddenly discovered I was retired. Now, fortunately, my wife and I had no debt, a large cash cushion, and I had maxed out retirement savings. I quickly learned how to manage based on lessons learned from retirees on a traditional path, as well as those who are on the financial independence retire early path. Some principles apply no matter how you enter retirement. So even though I hope you don't follow my crash landing, maybe you'll gain some insights from these thoughts. By the way, please take a moment to like and subscribe to this channel if you like entertaining ideas. The more you smash that like button, the higher this channel will be in the YouTube search results. And comment with some lessons learned in your retirement. The first big mistake I'll share is for those in their 40s who are not contributing enough to earn a full employer match. Now, my buddy Steve at Steve's Retirement Corner recently posted a video praising his 401k. It helped him get there to his retirement. And he noted some financial planners don't give the 401k enough credit. Now, that's true. All retirement plans are not perfect, but those that offer a good mix of investments and low cost with an employer match can help you save for retirement. The secret is to understand your choices and how to use them to the fullest. If your employer matches your contribution, make sure you know the rules and contribute enough to earn a full match. Otherwise, you're leaving money on the table and not taking the best advantages. There is an investment in your 401k that pays 100% return. Now, not all employees have access to an employer match, but most large employers do. Deloitte recently reported that 85% of employers offer some form of match. The most common formula are 100% of the first 4%, 100% of the first 6%, or 50% of the first 6%. Know your rules. So if you're earning $70,000 a year and you are contributing your 6%, that's $4,200 in payroll deductions, and your employer is matching 50%, so $2,100 of your dollars just earned a 100% return. Your employer contributed another $2,100, giving your 401k a total contribution of $6,300 for the year. Now find me another safe investment that doubles your money like that. If you are only contributing 2% to your 401k, and that's $1,400 a year, your employer is only going to kick in $700. You are missing out on all the rest. So make sure you contribute enough to qualify for the full match for your plan. Talk to your benefits team. By the way, under Secure 2.0, employers and employees will soon gain the flexibility to have the employer match go into a Roth 401k where it can grow tax-free for your retirement. The second big mistake in your 40s is carrying expensive credit card debt. Now, I get it. You're paying off a mortgage and maybe a student loan, and you have a few credit cards with balances. But trust me, you need to pay off those credit card bills as soon as possible. Wallet Hub reports that the average credit card rate is about 20% now. Ouch! So after contributing enough for the employer match, your next priority is to pay off those credit cards and then commit to paying them off at the end of each month. Use the float, but avoid drowning in debt. Build up an emergency fund of 6 months so you don't need to use a credit card debt to pay for the unexpected auto repair. I put out a video a while ago about what rates rate, with some helpful links on how to get credit card balances under control. The third big mistake in your 40s is the failing to plan for the future. You may think you are 20 years away from retirement, but now's the time to put together a formal financial strategy. How much do you need to save for retirement? What savings vehicles make the most sense? Do you need to save money for a college education? Should you be using health savings accounts? I never had those opportunities. How much should you put in pre-tax 401k or after-tax Roth 401k? You don't need to spend a lot of money on a financial plan or hire a fee-only financial planner. There are online tools like Personal Capital, which is now called Empower, where you can start using their planning software for free. Your employer may offer free financial planning programs too. Learning to build your own plan is probably the best option. Think of the fees you'll save. For those in your 50s, the first big mistake I want to talk about is not having a plan to pay down debt, including your mortgage. By my 50s, we had made sure to retire the mortgage before I was retired. We began by using double payments on a 30-year mortgage to gain equity, and then refinanced into a 15-year mortgage. And early in my 50s, I decided to use a windfall to pay off the final balance. I compared the prepayment of the mortgage with other bond investments available to me. I didn't compare what I could do by investing that money into equity, because mortgage is not like equity. It's more like your fixed income bond investments. The second big mistake for those in the 50s is not making catch-up contributions in your retirement savings. When you are in your 50s and older, the tax code gives you an extra opportunity to contribute to your retirement. In 2023, older workers can contribute an extra $1,000 to an IRA or $7,500 to employer-sponsored plans like 401ks and 403bs. Starting next year, those limits will be indexed with inflation and will go up every year, giving you more opportunity to max out your retirement savings. And the third big mistake is failing to build up a cash cushion. 6 months of an emergency fund may be enough earlier in your career, but in your 50s, you need to build up at least 3 years of expenses in cash in case you suddenly find yourself between jobs in your 50s and ageism is real. You may even discover that you're in the same boat that I was when I was retired. Now, I had an option of deferred compensation in my last 2 jobs. In both cases, I deferred part of my compensation until after I separated. Essentially, I was funding my own severance plans. Now, you may build up a cash cushion with a deferred comp plan, or cash in the bank, or a home equity line of credit. You just want to make sure that you have access to cash coming in if you suddenly find yourself retired before you expected. For those in your 60s, I'm going to begin with this mistake. Too often, people decide to take Social Security as soon as it's available to them at 62. I just did a few videos on this, so see those, but in most cases, you want to wait until at least your full retirement age. For those just entering your 60s, that means waiting until 67. If you are married with someone who counts on your spousal or survivor benefits, consider waiting until 70 for the maximum benefits. The second big mistake is not planning for the transition from employer-sponsored health insurance to Medicare. If you are retired early, you will have several years before Medicare. And in my case, that meant buying health care coverage for the two of us on the Affordable Care Act marketplace. If you're still working before you retire, be sure to know your benefits and what you have and when you will need to file for Medicare Parts A and B. Begin researching options before you turn 65 so you can make informed choices. Finally, the third big mistake for those in their 60s is to rely on what I call an AllThumbs retirement plan. Some people plan a retirement that will follow all those rules of thumb, like the 4% withdrawal rate. You only need 80% of your pre-retirement expenses. You should always spend taxable accounts first, then tax-deferred, and finally tax-free monies. Those are rules of thumb that may not apply to you. Take time to build a bottoms-up budget and a retirement withdrawal strategy that makes sense for you and your priorities. I will conclude with my standard warning. I am not a financial planner. I have no initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. See you next time.